How will the current rates, evictions, and potential foreclosures impact the real estate market? Coming up in your weekly market update. Mortgage rates continue to float around 2.71%, which is still record low rates. While jobless claims have continued to increase, there are no projections for mortgage rates to increase at this time. Trends show that home price growth is at a record high, raising at its fastest pace since the early 2000s. Starting January 1st, landlords will once again be able to legally evict tenants for failure to pay rent. December 31st is the last day of protections from evictions and from a handful of other coronavirus relief measures that will expire on December 31st if there's no stimulus or new executive action to renew them. The National Low-Income Housing Coalition estimates as many as 19 million people in 6.7 million households are at risk of being evicted when the calendar flips to 2021. This could mean an increase in listings in 2021 if new protections are not implemented. Many investors may take the opportunity to take advantage of the current seller's market to cash in on their unoccupied rental properties. More than 3.3 million U.S. homeowners will be on the hook for delinquent payments when their mortgage forbearance ends, while some of those homeowners who are over-leveraged or unaware of their options will continue to increase the wave of foreclosures. Most will be able to work with their lenders to either refinance or maybe even sell their homes. American homeowners have gained $2 trillion of equity since the beginning of this pandemic, thanks to double-digit price growth driven by soaring homebuyer demand and a low inventory. And an implementing wave of foreclosed homes will only make a small dent in the inventory drought. First-time homebuyers and investors will likely quickly buy up any foreclosed homes, leaving the larger housing market unimpacted. At the peak of foreclosure crisis in 2010, the national average loan-to-value ratio was 94%, meaning the average homeowner owed their lender nearly as much as 94% of their home value. As a result, many financially stressed homeowners couldn't even afford to sell their homes after the fees to actually sell a home, so they often ended up in foreclosure. Currently, the average loan-to-value ratio is 70%, meaning that the average homeowner has about 30% equity in their homes. This will allow the homeowners who are behind on their payments to sell their homes and use their proceeds to restructure their finances. Thanks again for watching another Monday Morning Market Update with Thomas Pulaskis. I hope to see you guys very soon. Ask me any questions, any concerns, and make sure to call or text when you're ready to buy or sell a house. Thanks a bunch.